everybody, and welcome to our first webinar in 2025. In the next 30 minutes, I would like to give you a short overview of the performance of listed private equity last year and what we expect in the year to come. But for those who don't know LPX yet, I give you a short introduction, just 2 or 3 minutes. LPX was founded in 2004, and we have been the first provider of a benchmark that measures the performance of private equity investments and can be used in the same way like any other performance benchmark, like a benchmark for global stocks like the MSCI World, or a stock for US, an index for US stocks. So with this benchmark, it was at that time the LPX 50, we are able to measure the performance of private equity and do this on a daily basis. As I mentioned, we have been the first ones. In the meantime, we are also analyzing and researching infrastructure stocks. And since a couple of years, we're also analyzing listed private credit companies that provide credit capital loans to unquoted companies. So that's our focus: listed alternatives, listed private equity, listed infrastructure, and listed private credit. We provide benchmarks and research on those 3 asset classes. When we now focus on listed private equity, we have 3 types of companies that we analyze. The first group are direct investing companies, so that are typical private equity companies that are listed on the stock exchange and do invest from their own balance sheet in unquoted companies. So that's very close to what you expect from a traditional private equity investment. It's basically you have the managers that are looking for new investments, are looking to whom they can sell an investment company or prepare an IPO. So that's the typical private equity business model that you know. An example is Onyx or HBM Healthcare. That one is listed in Switzerland. Onyx is listed in Canada. Then the second group are fund of funds that are listed on the stock exchange. So companies that invest in closed-end private equity funds but are themselves listed on the stock exchange. There are not that many companies in that group, mainly because they're not quite welcomed by the investors, because you have a double fee layer in here. However, it's also an interesting subsegment because some of those companies trade at very high discounts. And then the third group are fund managers that manage private equity funds and generate fee income from managing those private equity funds. Those companies are well known, like Blackstone, KKR, and I will provide a few examples on those type of companies at the end of the presentation. Now, when we have a look at the total private equity market, private markets have reached an all-time high of more than $13 trillion last year. So we still have a very strong growth in this asset class. And of course, this also correlates to listed private equity because, as I mentioned, there are also fund managers part of that segment, and they are profiting from this growth in assets under management. So part of the performance drivers is also the growth of assets under management, because as a fund manager, you generate fee income from that from those assets, and by definition, you will then also see an increase in your profits. So part of the performance is also driven by the growth of the asset class, and that's kind of unique because by investing in listed private equity or by investing in the subsegment of listed private equity fund managers, an investor is also profiting from the growth of an asset class. And when we now have a look at the performance, let's start with the long-term performance over the past 25 years. You have a very long-term performance chart here. It starts in 99 compared to to global stock markets. And as you can see, there's a very strong outperformance in general of listed private equity. However, in the short term, when you look at shorter time frames, there can be a very high correlation between private equity and global stocks. This shouldn't be a surprise, because when the stock markets are growing, then of course it's much easier to sell an investment, to perform an IPO of an investment company. So there should be a link between the growth of the stock market, the performance of global stocks, and the performance of private equity. And in addition, when you have an increasing stock market, also the EBITDA multiples or price to earnings ratios usually go up, and those are the basis for the valuation of unquoted private equity investments. So this shouldn't be a surprise. However, in the long term, as we can see here, there's a very strong outperformance over the past 25 years. When we have now a look at the past 15 years, so since the financial crisis, this is now the LPX 50 index. The LPX 50 index measures the performance of the 50 largest listed private equity stocks and contains all three groups of private equity companies that I have mentioned at the beginning of the presentation. So last year we have seen 32.8%. This is measured in euros. Of the past 15 years, we have seen a performance every year of around 17.65% on an annualized basis. So again, here we have seen a very strong outperformance, and also last year, the year before. So this shows the private equity drivers, the performance drivers are still intact, are still working, and part of the performance are successful exits, are valuation increases of the portfolio investments, but are also increases in the asset under management of the listed private equity fund managers. Now let's have a look at two very important subsegments of the private equity market, buyout and venture capital. Apart from the stock price indices, we also measure the underlying NAV returns. The NAV returns are measuring the performance of the book value of the individual investments. So basically, it's measuring the fundamental performance, which is reflecting, how good a private equity manager is doing his job, because the NAV returns are reflecting the valuations, are reflecting exits. So it gives you a very good performance implication of the typical private equity investment, and it's not including the macro factors that influence the price or stock market return. So for buyout, we have seen around 12% increase last year, whereas in venture capital, we have seen a decrease of almost 5% of the NAV valuations. What we have seen is that, especially in the venture capital segment, there is still a very high correlation between interest rate changes and valuation changes. And the main reason for that is that venture capital investments are usually valued at a net present value model, which takes into account the future cash flows. And those future cash flows are discounted with an interest rate. And as interest rates change, this has a heavy impact on the valuations. Now that everybody expects that interest rates go down this year, so for example, in Switzerland, we expect negative interest rates by end of the year. But even in the US, our personal view is that the interest rates will also go down this year. So decreasing interest rates in the end would mean that venture capital investments, or the valuation of venture capital investments, will increase, because then the net present value is higher. It's a very technical thing, but for venture capital, that's still the case. In buyout, the interest rate changes are not that correlated with the valuation of buyout investments simply because the valuation of buyout investments typically rely on price to earnings multiples or EBITDA multiples, or basically on multiples that are based on cash flows of the underlying business model. Of course, interest rate changes also have an impact there because the valuation or the deal or buyout deal is cheaper when interest rates go down. It's also easier to do a buyout deal. However, it's not that correlated as in venture capital. So the performance driver of buyout investments is mainly driven by the underlying business model of the individual investments. So this last year, 12% performance of buyout. Over the past 10 years, we have seen an NAV return of 136% of buyout and invention of around 28%. And this is all measured in US dollars. Over the past 5 years, as you can see on the left-hand side, NAV return of around 49% for the global market, for 66% for buyout, and minus 1.8% for venture capital. And the negative return over the past 5 years in venture capital is mainly driven by the interest rate changes, because when the interest rates went up 2 or 3 years ago, based on the inflation increase, we have seen a strong decrease in the valuation of venture capital investments. But again, as I mentioned at the beginning, we expect that interest rates will go down this year, and we also expect that venture capital investments will increase in the year to come. Some top performance over the past 10 years. Here you see the total return over the past 10 years. One of the best performing companies is Ares Management. As you probably know, this is an asset management company. So the performance driver here is mainly the very strong increase of the assets under management, where 3i Group is a direct investing company. So the performance driver here are valuation increases of the portfolio investments. Then you see another handful of asset managers, and then HG Capital Trust, a UK listed private equity manager. And here also they are investing from their own balance sheet. So you also get here a good insight into the performance drivers of, on the one hand side, the listed private equity fund managers, and on the other side, the direct investment companies. However, what I think is much more interesting is not the stock price performance, but the underlying NAV return of those companies. So here you see 3i Group as the top one over the past 10 years. So they were, as I mentioned, able to increase the valuation of the investment portfolio by almost 8 times. HG Capital, 400%, Oakley Capital, 300% over the past 10 years. This is nice to see that the performance driver are really increases in the valuation. And we expect that also to be the case in the next year. And why this is the case, I will show you later some more insights also in the discount level. So when we now have a look at the dividend yield of the past more than 10 years, so on average 4.6% over the past 14 years of listed private equity, and the dividend yield is based on exits on capital gains, which are then in part paid out to the investors. So also for listed private equity and including listed private equity fund managers, we see interesting dividend yields of that segment, which again is driven by fundamental performance drivers like valuation increases or successful exits. Now let's have a look at the discount level. So because we measure both the stock price performance of listed private equity stocks, but also the NAV performance, we are also able to measure the premium and discount by comparing the stock price and the NAV performance. We also do this on a daily basis. Here you see the discount level end of last year, which was around 15%. We still see discounts. And when we now have a look at some examples, we see discounts at a very elevated level. Like Eurozero, it's a French listed private equity company, around 40%. Castle Private Equity, 40%. Onyx, which I mentioned at the beginning, 32%. So the companies still trade at very high discounts. However, when we look at the valuations, when they sell an investment, when they perform an IPO, we realize that the companies are able to get valuations that are higher than the valuations in the balance sheet, which means that the discount level is still underestimated. It should be much higher when you calculate that on an exit basis, which then means that the valuations are conservative. So the discount is not reflecting that the valuations have to come down or that the portfolio investments are bad investments. No, the opposite is true. The discount level is more reflecting a market sentiment, and it shows that despite the very good performance over the past years, there is still value in those companies, and we don't see a bubble when we look at the discount level of those companies. That's also the main reason why we are quite optimistic for the coming years. And also when we look at the fund managers in a second, we also don't see a bubble there because the performance is mainly driven by increases in assets under management. So summing up, we see a very positive outlook for private equity. We also expect that assets will grow in the coming years simply because interest rates are now again, especially in Europe and Switzerland, but we expect that also to be the case in the US. Interest rates are now at a level where investors now need to look for alternatives because they need a yield, and you still get it in private markets. Also, the deal activity was significantly higher last year than the year before. And what is very interesting, according to BlackRock, we also saw that the distributions were higher than the capital calls last year. So the fear that we have seen in 21 and 22, that investors don't get their money back, is not the case. We see that distributions are significant, and we also see this in listed private equity companies. As I have shown you, we see significant and interesting dividend payments. We see capital buybacks. We see share buybacks. So companies also see that the discount level is not justified, and one of the best investments they can do is to buy back their own shares. Now, given with the new US administration, we also expect that regulation will help the industry in general, because we expect that we will have less regulation, which on the one hand side will help the asset class as a whole, because we expect it will be much easier to invest in private equity in general. And on the other side, less regulation always means that industrial companies from every sector will be much easier for them to do business, to increase business, to grow. So that will definitely have a very positive impact for private equity in general. So now in the last few minutes, I would like to show you two case studies, two companies that are part of our universe, of our indices. One company is a direct investing company, and the other one is an asset manager. So from those main two groups, I will show an example. One is HG Capital, listed in the UK, and they also mention HG Capital funds, closed-end funds. And it is one of the best performing stocks in that universe. As you can see on the right-hand side, the stock price performance is very impressive. And the main reason why they have such a good stock price performance is because the management is very experienced, and they are also very experienced in during crisis, during recessions. They were always able to invest during a recession when the valuations were at a very low level. They were able to refinance their companies. They were never forced sellers, so they were always able to keep their investments and wait until a crisis or recession is over, and then wait for the next for the best valuation. And this is again one of the other advantages of listed private equity, that you are able to wait. You don't have to sell because the companies are structured as an evergreen, given that there are stocks listed on the stock exchange. So there is no need to sell at a certain point in time. So you can sell, but you are not forced to. You can simply wait when it's not the best time to perform an IPO or to sell a company. And again, HG Capital is one of the best managers that have proven over the past decades that they are regularly able to outperform the market and to optimally time their investments and their exits. Another company that I would like to show you is an asset manager. And when we have a look at the assets under management for the total market from the listed private equity fund managers, we see a very strong increase, almost 14 times over the past 15 years, from around 200 billion to more than 4 trillion in assets under management. That's now measured in euros. And this is another advantage. By including the fund managers in that universe, we also profit from the growth of the asset class as a whole. And this is a very unique situation, because you usually are not able to participate in the growth of an asset class. And here you have a very easy access to that growth. And one very nice example is KKR. You see here on the left-hand side at the top, the stock price performance of KKR. Very impressive. I don't think I have to mention a lot or to add a lot to that. Last year, the performance was more than 90%. This is now again measured in euros. And the performance is driven by the growth of the assets under management, almost 25 times over the past 20 years. So again, we don't see a bubble here. Of course, the market assumes future growth in assets under management. However, the stock price over the past 10 years, past 15 years, is driven by the growth of assets under management. So now I'm at the end of this webinar. Again, in case you have some questions, please feel free to contact me directly. Otherwise, I wish you a great time, and thank you very much for your time. And I would like to see you or hear you again at our next webinar. Thank you very much.